Welcome to Talk Tickers. We're your deep dive into the numbers and the narratives behind the big earnings calls.
Glad to be here.
Today, we're really zeroing in on a specialty lending corporation, specifically their third fiscal quarter 2025 conference call. It happened just recently, August 5th.
Right, and this is one of those BDCs, business development companies, operating in that direct lending space.
Yeah.
You know, providing capital where maybe traditional banks aren't playing as much.
Exactly. So our mission today really is to cut through some of the noise, get past the headlines, and look at what management actually said. Performance, strategy, the outlook.
And what it means for investors, right?
Yeah.
'Cause that's the key takeaway, weighing up those prospects.
Absolutely. So let's start with the results snapshot, the numbers and that immediate market reaction, because there definitely was a reaction.
Oh, yeah. The stock took a hit after the release. It was trading lower in pre-market and, well, it closed down for the day. Seems like investors were kind of bracing for some softness.
And the volume figures backed that up, didn't they?
For sure. Volume spiked up to 1.28 million shares. That's what, roughly 2.5 times the normal 30-day average?
Yeah.
So yeah, a lot of shares changing hands.
Okay, so let's get into those core financials. The NII figure.
Right, the adjusted net investment income, NII, came in at 37 cents per share. Now, the consensus estimate, what analysts were expecting, was more like $0.46.
Wow. Okay. So that's a pretty significant miss.
It is, about 20% below expectations. That definitely got people's attention.
I bet. And what about the top line, total investment income or revenue?
That also fell short. $75.3 million reported versus the $79.1 million consensus.
So about a 4.8% miss there.
Yeah, and maybe more telling, it was down 21% compared to the same quarter last year when it was $95 million. Yeah. So revenue down and the NII, the income from investments, even further off the mark.
Stark numbers. But, you know, income is one thing. What about the balance sheet, the NAV per share?
Good point. Net asset value, NAV per share, landed at $16.76. Now, that's actually down 7.9% year over year. So while income took a hit this quarter, the underlying book value per share also slid compared to last year.
Right. And leverage. How are they looking there?
Net leverage was 0.93 times.
Yeah.
Interestingly, though, they kept the base dividend steady at $0.40 per share.
Despite that NII miss. Definitely
Yes.
something to dig into.
Yeah. And one last number for context, non-accruals. Loans not earning interest. They represented 3.2% of the portfolio's fair value. So yeah, pretty complex picture financially. You can see why the market reacted cautiously.
Definitely a mixed bag. Okay, so the obvious question, especially with NII missing by 20%, how did management explain it? What was the CEO, Armen Panossian, saying?
Yeah, that was, the main event on the call. Panossian acknowledged the drop, but he pointed fingers mostly at what they called non-recurring and non-cash expenses.
Okay.
Tied specifically to some recent refinancing they did. They flagged $3.9 million in accelerated deferred financing costs hitting the P&L.
Accelerated deferred financing costs. That sounds a bit like jargon. Can you break that down? What is that and why the big impact?
Yeah, good question. So think about it like this. When you take out a loan, there are upfront costs, right? Fees, legal stuff. Companies usually spread those costs out over the loan's life.
Okay, amortize them.
Exactly. But if you refinance or pay off that loan early, any of those costs you haven't expensed yet, boom, you have to recognize them all at once. That's the acceleration.
Ah, got it. So because they restructured their debt, they had to take this immediate non-cash hit for the old loan's remaining setup costs.
Precisely. It dragged down the reported NII for this quarter. But it's, a one-time accounting thing related to that specific refinancing.
Okay, that clarifies the $3.9 million. But wasn't there something else? Less non-recurring income than usual?
Right. They also mentioned that. Things like prepayment fees, maybe some one-off gains from portfolio companies, that kind of stuff. It came in about $2.1 million lower than their average over the last couple of years.
So a double whammy then. A specific one-off charge plus less of the usual bonus income.
Yeah, basically.
Yeah.
Just didn't get those extra boosts they sometimes see.
But despite all that noise on the income statement, you mentioned NAV actually nudged up slightly quarter over quarter.
It did.
Yeah.
And that's an important nuance, I think. While NII looked weak because of those specific items, the small NAV bump suggests they're making some progress behind the scenes.
How so?
Well, it likely reflects them successfully restructuring or maybe exiting some of the more challenged investments in the portfolio. So even if income was down for the quarter, the underlying value of their assets may be stabilized or slightly improved. That's, potentially a good sign for the longer-term health.
That's a really key distinction. Okay, speaking of health, they kept that $1.40 base dividend. That feels like a sticking point given the NII miss. How comfortable did management sound?
Yeah, they definitely addressed it. They sounded comfortable citing those add backs, basically saying, look, if you ignore that one-time refinancing charge, our actual cash earning power is better. They also talked up a strong pipeline of new deals, good visibility on prepayments coming in next quarter, and progress turning some non-earning assets back into income producers.
Oh.
The message was, we see enough coming down the pike to support the dividend.
Okay, that makes sense. And it leads nicely into what sounds like a definite positive from the call. Their balance sheet work, strategic financing moves.
Yes, this was a clear bright spot. They successfully amended and extended their main credit line, their senior secured revolving credit facility.
Okay.
Got a better interest rate drop from SOFR plus 2.00% down to a range of SOFR plus 1.75% to 1.875%, and pushed the maturity way out to 2030.
And maybe just quickly, remind us what SOFR is and why that rate cut matters.
Sure. SOFR is the secured overnight financing rate. It's basically the benchmark rate that replaced LIBOR for a lot of loans. So getting a lower spread over SOR just means their borrowing costs are lower.
Like refinancing your mortgage at a better rate.
Exactly. Less interest expense means more potential profit, or NII in their case, and locking it in until 2030 gives them a lot of stability.
And they didn't just improve that facility, they got rid of another one too.
That's right. This new, cheaper facility let them terminate a more expensive ABL facility. ABL is asset-backed loan.
Gotcha.
That one was priced higher at SOFR plus 2.35%. So ditching that expensive debt and replacing it with the cheaper, longer-term revolver, that's going to lower their interest costs going forward. It's definitely accretive, meaning it should boost earnings down the line. Smart financial housekeeping.
Definitely sounds like it. So lower borrowing costs, longer maturity. What about just overall liquidity? Do they have cash ready to deploy?
Loads. They flagged about $730 million in total liquidity.
Okay.
That breaks down to $80 million in cash on hand and another $650 million they can draw down from their credit lines. They do have unfunded commitments of $278 million, promises to lend later, but they have more than enough firepower to cover that and make no investments.
And that 0.93x net leverage, where does that sit in their target range?
It's right at the low end. Their target range is still 0.9x to 1.25x. So their position conservatively right now gives them room to add leverage if they find the right opportunities.
Okay, let's shift gears a bit to the investment strategy itself and the market they're operating in. The CEO mentioned M&A activity is still pretty quiet.
Yeah, he pointed to tariff uncertainty as a key reason. Companies are still hesitant about big M&A deals.
Right.
So the knock-on effect is that instead of seeing lots of new buyouts that need financing, the market focus has shifted more towards just refinancing existing debt. Fewer brand new opportunities coming through that channel.
And I guess competition from things like CLOs doesn't help either.
Exactly. CLOs, collateralized loan obligations.
Yep.
When there's a lot of CLO issuance, it means there's tons of capital chasing deals in the bigger, broadly syndicated loan market. They can pull some deals away from private credit lenders like this company, and it also tends to push down spreads, the interest rates lenders can charge. It just makes for a tougher, more competitive environment.
So, given that backdrop, how are they still finding value? They seemed pretty confident in their ability to originate good deals.
They did. They really leaned on their expertise in the middle market. Originating and structuring loans directly with these medium-sized companies. And the numbers kind of back it up. Their weighted average yield on new debt deals was 9.1%.
Which is pretty close to the 9.5% last quarter.
Right. But here's the kicker. They said they're still capturing yields in the mid-500s, including OID.
Okay. Mid-500s, including OID. Let's unpack that. What does that mean?
So mid-500s means about 5.5% spread over the benchmark rates, like SOFR or SONIA. OID is original issue discount, basically getting a bit of extra yield because they buy the loan for slightly less than its face value up front.
Ah, okay.
So putting it together, their all-in yield on new loans, considering the interest rate in that discount, is significantly higher than the general market.
Yeah.
Market average for new private credit deals right now is maybe SOFR plus 425 to 475 basis points. They're getting SOFR plus 550 or so.
So that's a meaningful premium they're capturing. Suggests they're finding deals others aren't, or structuring them better.
That's the implication. In a market where everyone's saying spreads are tight, their ability to still get these kinds of yields suggests they have Maybe better sourcing, better relationships, or expertise in certain niches.
What are those niches? Where are they focusing their new investments?
They mentioned a few key areas. First lien, middle market loans. That's this safer senior part of the debt structure. Then asset-backed finance.
Like what kind of assets?
Things like rental car leases,
Yeah.
HVAC system loans. But they made a point of saying they're avoiding consumer unsecured debt, which can be riskier.
Okay.
Also targeting life sciences and making an early push into Europe and the Asia-Pacific regions, where they think spreads might still be wider than in the U.S. They even mentioned looking at infrastructure debt. So it's a pretty diversified approach across different sectors and geographies.
And what about PI income, payment in kind? Where do they stand on that?
They seem pretty conservative there. PIK income, where you get paid in more debt instead of cash, was only 6.7% of their total income. That's apparently near the low end compared to their peers.
Which is generally seen as a good thing, right? It means more cash interest coming in.
Yeah, it generally indicates healthier borrowers who can actually pay their interest in cash. It makes the income stream feel more sustainable, especially for covering that dividend.
Makes sense. Did they give any specific examples of recent deals, the co-CIO?
Yes, the co-chief investment officer did. Highlighted two recent first lien deals. One was Draken International.
Okay.
They provide operational training for air forces, kind of an aerospace and defense play, sourced via Blackstone. They like the counter-cyclical nature of that industry. Priced at SONIA plus 550. SONIA being the UK benchmark rate.
Got it. And the second one?
Lions, Magnus. They're a food and beverage company, big into plant products. Apparently have long relationships with places like Starbucks and McDonald's. That one was sourced via Ping Schwartz Partners. So you see a pattern. Established businesses, often sponsor-backed, in resilient sectors.
Okay. And on the other side of the coin, managing problems, any movement on non-accruals?
Yeah, a bit of give and take. They did add one new loan to non-accrual status, Baymark. It's a substance abuse treatment provider facing some operational liquidity issues. But balancing that out, they took Telestream Holdings off non-accrual. That was a video software company. They completed a restructuring there, so it's back to performing status. Shows they're actively working these problem credits.
Any big wins on getting money back from older problem loans?
Yes, actually. Some meaningful exits and recoveries. They got $25.7 million in cash back from Mosaic, which had been a challenge name. And another loan, Alto, a digital pharmacy, got paid back at par, even though it had been marked down before.
That's significant. Frees up capital.
Exactly.
Yeah.
That cash isn't stuck anymore. It can be put back to work in new earning investments.
So looking ahead, how does management plan to actually boost earnings and, really secure that dividend, especially after this quarter's miss?
Well, first, they sounded pretty positive about their pipeline, the depth and diversity of potential deals. Plan A seems to be gradually increasing leverage.
But didn't they say not to the top end of their range?
Correct. They specifically said towards the midpoint of their 0.9x to 1.25x target. So maybe aiming for around 1.1x, something like that. Controlled, not aggressive.
Okay. What else?
Utilizing their joint ventures more. They have these JVs where they co-invest with partners. They're currently leveraged at 1.3x, but the target is 1.5x. Pushing those harder generates more earnings off their main balance sheet.
Right. More bang for their buck.
Yeah. And finally, just redeploying that cash from the successful exits we just talked about, like Mosaic and also EOS Fitness was mentioned. Getting that money out of non-earning assets and into new loans that pay interest, that's the playbook.
Okay. So stepping back, as an investor listening to this, what are the really crucial takeaways from the call?
I think the main thing is seeing how a direct lender like this is navigating a pretty tricky market right now. Spreads are tight, M&A is slow.
Right.
But their ability to still pull in those mid-500s yields on new loans, that really stands out.
Yeah.
It suggests their strategy focusing on specific niches, geographies, using their relationships is actually working. They seem to be finding pockets of value others might be missing.
And the bigger picture for direct lending still looks pretty decent, doesn't it? Good yields, focus on capital preservation seems attractive in this environment.
Generally, yes. But for this company, the elephant in the room is still that $1.40 dividend. Can they sustain it?
That's the tension.
Exactly.
Yeah.
Management lays out a credible plan, add a bit of leverage, use the JVs, redeploy cash. They sound confident. But you had the NII miss this quarter, And you know the sell-side analysts are skeptical, talking about an unsustainable payout. So as an investor, you have to weigh management's story against those headwinds and that skepticism.
So what should people be watching for in the next few quarters to see how this plays out? What are the key catalysts?
Okay, number one, Q4 earnings. That'll be early November. Need to see if NII bounces back without those one-time refinancing costs. Does the core earning power look better?
Makes sense.
Second, watch the joint ventures. Do they actually increase the leverage there? Deploy more capital? Third, what happens with Baymark, that new non-accrual? Can they resolve it? And fourth, just the macro picture. Does M&A pick up? That could really boost deal flow and fees for them.
Right. So it boils down to whether that current, 11% dividend yield is a genuine value opportunity or potentially a value trap.
That's a debate, yeah.
All right. So let's put on our hypothetical investment committee hats for a second. And as always, this is just for discussion, definitely not advice to buy or sell anything.
Purely thought experiment territory.
Exactly. But given everything we've just discussed, the mixed results, the market reaction, the management plan, here's maybe an outrageous but plausible idea.
Okay, let's hear it.
Well, the market seemed pretty downbeat right after the earnings, right? Stock drifted lower. Maybe, just maybe, a lot of that NII softness and the dividend worry is already baked into the price now.
Possible. So what's the trade?
The idea could be sell short-dated, out-of-the-money put options on the stock, maybe those expiring after Q4 earnings.
Interesting. Selling puts means you're betting the stock won't fall below a certain price by expiration. What's the rationale?
It hinges directly on what management laid out. One, their plan to increase leverage, but only to the midpoint, showing control. Two, actually redeploying that cash from Mosaic, EOS Fitness, those successful exits, that's real capital going back to work.
Okay.
Three, their proven ability, even now, to find those higher yielding deals, middle market, asset-backed Europe. If they start delivering on those points in Q4,
The market might start to believe the dividend story more.
exactly. The market might reevaluate. Plus, don't forget that fundamental improvement we talked about, the lower cost of capital from refinancing their debt. That will help earnings in future quarters. So if they execute, even partially, the stock could stabilize, maybe even tick up a bit. Those OTM puts could expire worthless. It's basically a bet on management execution meeting improved fundamentals.
A bet that the Q3 report was more noise than signal for the future trajectory.
Precisely. It's betting the market overreacted a bit to the headline miss and hasn't fully priced in the strategic fixes and underlying strengths. So let's wrap this deep dive up. Third quarter definitely presented an initial NII miss. No doubt about that.
Yeah, the headline wasn't great.
But the call itself, digging deeper, it really painted a picture of a company making some smart moves on the balance sheet, improving their funding costs, and still finding decent deals in a tough market through disciplined origination.
Right. And management did lay out a pretty clear roadmap for how they plan to support earnings going forward. Controlled leverage increase, putting recovered capital back to work, using the JVs.
The core tension, though, it really still revolves around that dividend, doesn't it? Management's confidence versus that lingering market skepticism.
Absolutely. So your job as someone listening is to weigh that strategic clarity and those operational improvements against the immediate financial results and the market doubts. Think about how this kind of lender fits into the cycle and whether you believe in their niche strategy.
Well said. Thank you for joining us on Talk Tickers for this deep dive. Remember, all this information is just for educational purposes. It should definitely not be taken as financial advice.
Please do your own research.
Absolutely. We appreciate you tuning in, and feel free to reach out if you have follow-up questions or thoughts on this call or any others.